Let's take a look at oil today as well, holding above 82 bucks a barrel, near a 7-year high. And if you think the oil price spike is shaking investors, our next guest says, think again. Chris Verrone of Strategas is here to lay it all out. He was just ranked the #2 technical analyst on Wall Street by Institutional Investors. So literally in the pantheon of analysts. Chris, what are you looking at?
Thanks, Melissa. Well, listen, I think certainly crude 60 bucks to 85 bucks over the last 2 months. I mean, 40% move in crude. I think tangential to that, it's only natural to ask, what impact does that have on consumer stocks here? And that's the question we're getting from clients every day. It's what level crude or what level oil does it really start to weigh on some of these names? Now, I actually don't think that's the best question to ask. I think what we want to do is look how the market is interpreting higher oil. So I brought along some charts to try to do that. And I think the first one is a really important look here. This is the relationship between discretionary versus staples. And we equally weight this. So this is not Amazon versus Walmart. This is the average discretionary name relative to the average consumer staple. This actually has continued to work higher. So despite crude at 85, despite oil at big, you really have not seen the market get more defensive in the type of consumer stocks that are working. So this is going to be a really important guide for us. So far, this is saying the consumer can handle $85 crude. So we don't know what level oil is the problem. I think this relationship will help answer that question over time. So far, so good there. Now, what names can we actually buy against this backdrop? We brought along 4 that we like here. The first in the travel space, this is Marriott. Looking at here over the last 5 years, this 155 to 160 level has been major resistance really over the last number of years. Stock trades 160 today. I think it punches through here. It gives you a near-term target of somewhere in the 190 level. I think that's achievable. What's really interesting about Marriott, there's 23 analysts that cover it. There's only 7 buys. So I think as the stock breaks out here, you'll have to see the sell side upgrade it. Best Buy is another chart that we like here. It's been in the range for 12 months, frankly. It's been stuck in this 100 to 120 range. It's at the top end of the range. I do think it'll break out here. And just look how the relative performance there has turned. So we're beginning to see a name like this. While it hasn't broken out yet, it is starting to outperform the market. We think that precedes it breaking out. RL is another name that we like here. The Ralph chart, it bottomed near 100 in July. It retested that in September. It held. We think it turns back up here. The stock trades 125 today. I think it's on its way to 140. Those were the highs back in the first quarter. And then lastly, we would be remiss if we didn't talk about really our favorite name and our favorite group in the whole sector is the autos. This is Ford. I know up a lot today. That $18 level going back about 10 years has been a major hurdle. I don't think it's ready to break out quite yet. Let it come back to the 1550, 16 range. We think it's very viable on any pullback. Autos globally are in a bull market. So whether we look at travel or big box retail or apparel or autos, I think the message of the market is $85 crude is not a problem yet.
Chris, always great to see you. Thank you.
Thank you.
Chris Verrone of Strategas, Trader's Choice. Dan, do you like any of these picks? Do you say poo-poo to them? What's your take?
No, I like a lot of them, and congrats to him on that II ranking. He's a stud. Listen, I agree on the Ford. It's going to take a little time, maybe a little back and fill, but there's going to be an epic breakout coming in the not so distant future. Get a little of that Tesla EV pixie dust valuation on what they're doing. That makes sense to me, and I also like that Marriott one. That looks really good, especially if we have this pandemic in the rearview mirror anytime soon.
Same to you, Jeff. Which one do you like?
I want to stay in the higher end retail space. We talked about this a little bit, I think, a couple of weeks ago. And in terms of energy, I don't think it's catastrophic for the consumer, but it certainly hurts the lower end. You talk about 4% of overall consumer spending, 6% for the lower end. And I think there's some skew there because the higher end is spending on more cars and larger homes. So I think the impact of price change is going to hit that lower end more. I think around $4 a gallon in gasoline. We're not there yet, but moving in that direction. So we talked about Amex earnings, good spending volumes, good loan balances, but is that more an indication of the higher end consumer? I think maybe. So when you think about general retail, Gap, Urban, Kohl's, these are all stocks that have gotten killed. They're cheap now, but I'd still stay away in favor of some of the higher end retail names.